Hi, this is Patrick, and welcome to the Elite Wealth Podcast. This week, I'm joined by Matthew, and let's start off talking about what time do you put up Christmas decorations? Like, when do you do that?
What time would I like to, or what time would Hank want to?
Yes.
So my 6-year-old son, Hank, would love to do it today, right this minute. He would like me to go home from work. But I would rather wait until after Thanksgiving, probably the Sunday after.
So the question is, do you have to put up army men?
Actually, it's funny you bring that up. So he took his little army men, and we had the little box full of hangers, and he made ornaments out of the army men. So you come to our house, and there's a tank, and there's an army men.
That's perfect.
It's actually
That's awesome.
Funny.
Yeah, usually we normally do Christmas, get the Christmas tree right after Thanksgiving on Friday, which is a no-no for Catholics. We're supposed to wait much later. But yeah, we don't even do that much decorating outside anymore. We do around the house inside because we live kind of in a secluded area, so nobody really comes to see it. So what's the point?
What if we came?
Yeah, nobody ever comes to see me.
You put tinsel on the tree?
No, we do not do tinsel. Tinsel's terrible.
Yeah, trust me, I know.
God, that stuff's terrible. So this week, what we're going to do is we're going to be talking about 401ks, some of the changes that have come out with recent law on the 401ks. One, most notably, being referencing the change to your contributions. That's the catch-up. The catch-up contributions.
Super ketchup.
And super ketchup. Is that like with the super order fries?
I don't know if that's quite the same, but it might cost about the same.
So why don't you fill us in a little bit about the ketchup, super ketchup, and the changes?
Yep. So the big change is on a regular contribution to your 401k, you can contribute up to $23,500 a year. So the regular catch-up is you can contribute $7,500 on top of that for a grand total of $31,000. Now the super catch-up, a little bit goofy, but the ages between 60 and 63, you can actually contribute a little bit more. So an additional $11,250, so it'd be a grand total of $34,750. Now the goofy age range is, the thought being that's your highest earning potential.
Sure, yeah.
And if you haven't saved enough, that'd be a good time for you to add some more in there. So it's only for a certain amount of years.
Yeah. And you can actually contribute to a 401k beyond that as well.
Yep.
So I believe you can go up to over $60,000, I believe it is.
Yeah, I think it's actually 70 this year. They
70
bumped it
this
up
year?
a little bit.
Okay, so that you can actually contribute above and beyond yet. If you want to know more about that, you can either give us a call or visit the website, and we can answer those questions on it. But definitely some big changes. Another change that came through is that your catch-up contribution will not go into your pre-tax. So your catch-up contribution either has to go to one or two other places. One of the places would be into the Roth component, if you have that available, or into what we would call a brokerage account. So again, just so you're aware that those are some things that are different this year on that part. But I really wanted to talk more about the 401k and some other things in the 401k where I don't know if everybody thinks about this all the time. And we know not everybody watching is going to have a 401k. You may have a 403b, 457, or some other plan through your employer. One of the things that I think is interesting with the 401k is actually it's an annuity. And a lot of people aren't aware that it's an annuity. The accounts that you're investing in are what are called sub-accounts or mutual fund-like accounts. So they actually are not owned, or they're not like what you would get normally on the open marketplace, but they're actually owned by that company, whether it's Empower or Principal or whoever has that plan. So some interesting things of noteworthiness on that. But they also have a lot of they offered at least the option to have built-in living benefits. And the built-in living benefits where you can put on income riders and some other things like that. There's a fee for that, but I haven't seen anybody really take advantage of that. Have you, Matt?
No, not too many people, quite honestly. I think a lot of times when that's brought up, people are kind of unsure of what their options are.
I think the employers are unsure too.
Yeah. But I think, like you said, a vast majority of people don't take advantage of that.
Yeah. And one of the things that we do with our clients is we try to find out where they're working at, if there's payout options, what they look like, what kind of things they can do that might be competitive. Now, a lot of times it's not as competitive just because a lot of times you're looking at taking a pension style income. where you would have a lifetime distribution, either for your life, joint life, which would mean that your spouse passes, or a guaranteed payout period. I just have never seen anybody in the 20 plus years taking that option with a 401k. So, but it is out there. It's available. You can look into it, ask your employer questions about it. They probably will direct you to probably the rep for the plan, I'm guessing, because there's a lot of continuity there.
I do see some confusion sometimes where someone will come in and they get a statement that says, these are your payout options. So they think, that's my only option. I don't have the option to roll it over into an IRA and kind of manage the funds myself. And then typically, obviously, I just explain that, no, you have options to either manage it yourself, roll it out into an IRA, or you can take advantage of those payout options that you see on that. But it's just good to understand, number one, what your, different options are to choose from, so you can make the best decision for yourself. The other thing, you mentioned it before, with the catch-up, some people think, there's those two options of pre-tax and then Roth accounts that you can put your money into. And I've seen a couple instances now where somebody will think that the after-tax, or the brokerage account as we call it, is the same as a Roth, and really it's not.
Oh, yeah.
So
good point.
If you have any questions with that, that's why we're here. Obviously, reach out, take advantage, and just to make sure that you're getting the hard-earned savings into the right spot.
Right. Yeah, and there's a lot to know when it comes to the 401k, and a lot I think people aren't aware of when we talk about the 401k and just the different options that are available. And one of the things that I was thinking about with the 401ks are loans. So I've had several people recently saying, hey, what if we just borrow money from our 401k because we're repaying ourselves? Because normally the loan rate's like 8%. What I've seen on that, that's true. What I've seen though on that is that a lot of times those loans don't get repaid. And if you haven't payroll deduct out of your check to pay them down, it still takes a long time to pay those down. And then you can kind of get hemmed in a little bit when it comes to when you're retired and drawing those funds out. And what ends up happening, Matt, is that when you draw those funds out with a loan, and I know you know this, but you end up having to pay it as a distribution, whatever the loan balance is. So if you're going to borrow from the 401k, okay, you can do that, but be mindful that you want to get that paid off. The other thing, too, is that if you're invested in the market a year like this year, 8% is not even close to what the market did. So you might be giving up some time value of money where you're losing that earning power. So just kind of being careful. I know sometimes it can be a little more attractive than maybe going to the bank, but interest rates are starting to come down a little bit. So just, again, the tools are there. Be aware of them. Does it fit into your plan overall? Should you be looking at something a little bit different? Should you be modifying, especially when it comes to borrowing money out of your 401k and then how you pay it back? So anything you want to add to that, Matt?
No, nothing to that. Like you said, you see it every once in a while, but I think it goes back to really having a plan in terms of what you want to do. So if you want to, the best thing to do is to save the money, obviously, to have it there so that you can use it. But there's some instances where it does make sense to take advantage of the loan, but it's always good to have a plan of attack in terms of going into it, how you're going to pay it back and what that looks like, so we can figure out what the best decision is for you at the end of the day.
Yeah, and when it comes to contributing, a lot of times companies will do some sort of match, and it's always important, I feel, to take advantage of the match itself. But for a lot of people, I think saving in the 401k, especially with the Roth component, can actually be really, really of an important way and a disciplined way to save for your retirement. Because if you're just relying on you taking money out of your bank and putting it into an account for yourself, it might be kind of tough to do that because there's competing interests. We were talking earlier today about, if our phones are expensive. You have your cell phone plan. You have, how many other little apps running in the background, maybe streaming services that are costing you money. And all these things add up really quick. That, if you're not paying attention, all of a sudden you need that money and you aren't putting it away for yourself. Where a 401k deduction out of your paycheck, it's gone. You don't even see it. And I think that can be a really, really good way to go about saving, kind of a forced savings plan for yourself. And the way I look at it is that if you have the ability to be able to contribute to a 401k, really, quite frankly, for most people, you should be at minimum taking advantage of the match from that standpoint. So, I think that's pretty important.
Yeah, I think, some of the better advice I received when I was still in college is gentleman had challenged me to set aside 10 to 15% of my paycheck to put it into a Roth 401k if I had the opportunity to. And he said his explanation was, Matt, I was unmarried at the time. You're going to learn to live on your income, and then, if you choose to have a family, go that route, you're already living on that income. You're going to be putting yourself in a good position. And I'm glad I was able to do that and take advantage of it. But it's always harder when you don't start right away, right? Mm-hmm. You're always thinking, well, I got to pay bills now. I'll do it later. At later time, I'll deal with it. But if you do it up front, it makes it easy. The time value money is what we show people all the mm-hmm. time. How many times have we talked with someone in their 40s, 50s, and 60s, mm-hmm. and they wish they would have known some of the stuff when they were younger? It just makes it so much easier, and it gives you so many more options when you start at a younger date. And then with the contributions, the thing I'll say to that is, a lot of people will say, I put my contributions into the Roth account. And they said, all of my money is Roth. And I always ask them, are you sure of that? And what they don't realize is you may be contributing to the Roth account of your 401k, but your employer likely is contributing to the pre-tax account, which is a great thing, great benefit that you're receiving, but that's something that you always want to double check and make sure you're understanding.
And they did pass law where the employer can offer the mm-hmm. match to go into a Roth, but there's advantages for the employer to contribute to the pre-tax as well. So I don't see that as very commonplace yet, no. But it's something to definitely be aware of. And then, the other thing too on 401ks, because they're such an integral part of a lot of people's planning for retirement, I think there's just again, there's quite a bit there. Management, when it comes to management of the 401k, I just think that sometimes, a lot of people just kind of either pick the lifetime fund or life cycle fund, which is, when are you going to retire? I'm going to retire in 2035. Okay, you retire in 2035, you just put it all in there and you just let it go. And what we've noticed over time is, number one, when they first came out, good idea, because a lot of people didn't know it, and it's a basket of investments, and so you're not picking and choosing and having to figure out where to be. But then what ended up happening is that just by the nature of the fund, and what happens is in those funds is that closer you get to retirement, automatically they go more conservative. That may not be what you want to do. That may not be the best thing to do for your retirement plan. And or if the market's going up, you don't want to be necessarily going more conservative. So what I've seen is those life cycle funds tend to, number one, have a very large expense ratio, but then they pretty significantly underperform. They just have not done very, very well. So
yeah, a lot of times we look at it, just adding to Patrick's point, and you look at like a 2035 target date fund, mm-hmm. and maybe over the last 5 years it's returned 25-30%.
Cumulative.
Right in that ballpark.
Yeah.
You look at just like the S&P 500, a lot of times it's right around 100% over the last 5 years. Yeah. So a big difference in it's always kind of neat to show people that, just because they're like, holy smokes, I didn't realize by making a couple little changes that you have the ability to do, you can make a huge difference over the course of 5, 10, 15 years. So that's where a lot of times we'll be planning with people, figuring out their long-term goals, but then help coach them on, all right, these are the options you have available. Based on your risk tolerance, your outlook, maybe let's put it in something more like the S&P 500 to get a little better return historically over the long range.
Yeah, and usually they'll give a small, like a smattering of different investments across the board, from large cap growth all the way down through. And sometimes there even is the option to invest in company stock, mm-hmm. which can be advantageous, especially sometimes some employees are able to get what's called a warrant, where they can actually exercise the opportunity to be able to buy it at a certain price that could be significantly lower mm-hmm. than what the going price is. The downside is sometimes you're going to have to fund or front that money to be able to buy those shares, but it can be a tremendous way to go. But there's also some really great tax reasons why maybe you don't want to just roll that over right away. So Matt, do you want to talk a little bit about NUA and what that word means and how it works?
Yeah, so typically with the NUA, so net unrealized gains typically is what we're looking at. So there's a rule in terms of when you hold a stock, for example, longer than 1 year, you get a better tax advantage by holding it for longer than 1 year, where it switches over to long-term capital gains that if your taxable income is over $96,000 this year, up to 500 some odd thousand, you get taxed at a rate of 15%. If it's under that, and a lot of times in retirement, couples' income may go down, you can realize kind of piece by piece that company's stock and keep it under that $96,000 threshold and pay zero tax or very minimal tax.
Yeah. So that's rolling it out as stock
Correct.
is a big thing. So don't rush into a big hurry to roll that 401k over, because if you have company stock, you could be missing out on a huge opportunity. You know, I met with a couple. Actually, they've been clients for a few years now, and one of the things that when they came in, I noticed they both worked for the same company. They had a large amount of money in the stock itself, inside the 401k, and their advisor at the time had recommended rolling over the wife's account that had stock into an IRA they managed.
Mm-hmm.
Totally missed the NUA opportunity.
Is there tax on it all?
Well, they rolled it into an IRA, so they were okay
Okay.
from that standpoint. So it was inside the 401k, but now they missed that opportunity to be able to take it out at a very low capital gains rate. And they are talking about still trying to get rid of capital gains tax overall, which could be huge for people.
Yeah, I think a lot of people would be excited about that.
Oh, yeah. And then, you know, a nuance about rolling out in the NUA, the net unrealized appreciation, with company stock is that you have to be 59 and a half, first of all, to be able to do this. If you're 59 and a half and you roll out the stock, what you contributed or what you paid for the stock would be taxable.
Mm-hmm.
So you have to be kind of ready for that. But again, it still can be really, really a good deal. This couple, he still has a lot of stock, company stock. His basis is actually quite small. I think his basis is around $50,000-$60,000, but he's got $400,000 or $500,000 worth of value there. And just think that, you know, if we can, like you said, take a little bit out,
Mm-hmm.
that can really be a hugely beneficial way to be able to take out money that ordinarily would just be taxable as earned income. So just, again, being aware, I think sometimes in our industry, some advisors are just in a hurry to roll those funds over to manage them, and we might be missing opportunity. And I've seen it twice now in the last year where that opportunity was missed, different companies, but just totally missed that opportunity. I don't know, maybe just weren't aware of it. Maybe the client at the time didn't understand. I don't know what it was. But just walking away from or looking past that. The other thing too is that company stock, speaking of which, kind of being careful how much you have.
Mm-hmm.
This couple, he has a good majority of his 401k is company stock. And right now it's trading at all-time highs, and he's a little bit nervous.
Yeah, I can imagine.
So just, you know, again, so now diversifying, he's not 59 and a half yet. We have to wait. It's just, you know, do you want to give that up? Do you want to give that capital gains up? And here's the kicker too, is when I've done the projections for retirement for them, we're projecting that they're probably going to be in the 0% capital gains bracket.
Nice.
So now if we roll it into something, sell some of it and reposition it to like mutual funds or life cycle funds or whatever, we're giving that possible zero up. So now is this really like rock and hard spot where you're like, oh, I want to sell it because I got a lot there, but if I do, I'm giving up this tremendous tax opportunity. Again, a good diversified approach. It makes a lot of sense, and I think that's, again, where we come into play, is we're able to help folks be able to look at the 401ks, evaluate where they're invested, make recommendations on how they're investing, and really be, I think in most cases, put them in a better position overall. I've noticed that a lot of times when we reallocate a client's 401k into just individual mutual fund positions, whether it's the S&P or what have you, it's typically is done very, very well, relatively speaking. And like I said, they give you usually a smattering of options available on that. But just as a word of caution there, be careful with the amount of stock that you have for company stock in your 401k. It can be a really great thing, but make sure maybe your other investments away from the 401k also have some diversification away in some different areas. And I think, you know, what I'd like to do is talk a little bit about why the S&P 500 versus traditional asset allocation, especially in the last couple of years. Why do you think that's have you noticed that the S&P 500 has performed significantly better than what we call a truly diversified portfolio, which would be, you know, holdings of the large cap growth and value, and then mid and small cap growth and value, and having that well-rounded portfolio. But they have not performed very well, just really having that balance. And it's easy, I guess, or it's been easy to be enjoying the good returns of the S&P 500. So
Yeah, you look at like obviously with higher interest rates, the bonds haven't done great. Small caps we've been watching for a while, and they just haven't been stellar over the last couple of years, right? I think going back to right around COVID, right, was the last time that they had a better year. But to your point, really looking at the S&P 500 has done very well over the last 5 years. So it's hard to get away from it, especially when you see some of the returns.
yeah, you had the Magnificent Seven. Amazon came out with their third quarter earnings, and they crushed it. Result was stock was way up, and that says Mag Sevens. They're just crushing it, and it's hard to diversify away from that. You want to, but it's like you're giving up a lot. And talking more about the small and mid cap, where small and mid cap, I think there's a link and a tie to the national debt when it comes to that. Because when small and mid cap companies, they're usually trying to gain or trying to get some sort of cash flow, right? They're trying to generate some investing into their company, and sometimes they do that through bonds, or they go to the bank and they need that cash versus raising more capital and diluting the stock itself. But interest rates, even though the Fed has cut, I don't know if you noticed where the 10-year Treasury is at, about where it was at 6 months ago.
Yeah.
It hasn't moved much. It's today it came in today at 4.11, which is still relatively high considering they've cut the Fed's cut rates several times. I think they were down a full 1% from the high point.
Yeah.
And it's just still up there. I just that plays into, though, these small to medium-sized companies where they're trying to borrow money, but they still have a high cost. And that eats away on their profitability, and that makes their stock not look as attractive. And I think that the national debt is actually having a lot to do with why interest rates are still where they are, because quite frankly, we're just not seen as quite as good of a bet anymore on debt as we were, 10 years ago, where there was, I saw somebody had a Halloween costume, and one of them dressed up as the national debt, and it was $7 trillion.
Yeah, I think I saw the same one.
So I'm like, $7 trillion? It was either 7 or 10. And that wasn't that long ago, and now we're sitting here at 38 trillion, and it just gets harder for countries or other places to buy our debt. And that's why I've actually seen some articles about new quantitative easing, where the government's going to probably come in and start buying large chunks of national debt again. And all that is they just, instead of the print press on medium, they just turn it to high. And they just print more and more money, and they turn around and they put that, they're buying the debt back, puts more liquidity into the markets. But in the same token, it devalues the dollar, and maybe that's why we've seen gold do what it's done as well. I'm not so sure gold stays up where it's at. It's had a meteoric rise here. But I just be careful on the small cap. I know we kind of go off track a little bit sometimes.
Yeah, that's
get a
right.
little squirrel. But the again, seeing those, sticking with a large cap S&P 500 index fund in your 401k, hard to go wrong there.
And I think just talking through the education standpoint of it seems to help people feel more confident, feel better about their decision, because prior to having any discussions, most people come in, they sign the paperwork with their company, and they're like, I don't know, maybe I'm a conservative or a moderate investor, and they're 25 years old. It's like, well, no, you should probably crank it up a little bit too aggressive. You have a long time before you actually retire, and it's going to benefit you to be that aggressive investor. But without knowing, without having the education,
Yep. Well, it's that little bit, right? It's starting with that little bit, a little at a time, especially when you're young. I can't impress upon you enough, if you're a young investor and investing a little bit at a time, it's a lot easier to put away $50 a month than it is to have to put away $500 a month when you get closer to retirement. You just have that time working in your favor. You can take the risk. You can, if the rule of 72, Matt, rule of 72, what's rule 72? Quiz time.
You take 72, you divide it by your average return, and that's the amount of years that it takes to double your money.
Right. So if you got a 7.2% average return, it would take 10 years for your money to double. Now, the market's done significantly better than that. So if you're 20 years old, how many times do you think your money's going to double? 6, 7 times before you hit retirement. And then you're adding all the time. It doesn't take long before all of a sudden there's $1 million plus in there. And you're going to probably need that, quite frankly, if you're in your 20s now, because, you're in your 20s, right?
No, come on.
Flattery gets you nowhere.
Right. It's also interesting to see, though, you look at, it's cool to show people that are just starting out the charts in terms of, the first 300,000 is the hardest to come by. And then after that, it starts to compound a little bit faster just because of things, like you said, the Rule 72, dollars are bigger. It works more in your favor. But then the other thing is, as you're doing it, small habits make it easier over time. I think there's a graph out there that if you contributed from age 25 to 35, looking at saving $700,000 when you retire, you'd actually have a little bit more than if you waited until 35 and try to contribute the same amount of money just because you had so many extra years for that money to compound.
I'm so old it was $2,500.
Yeah, 25. Back in your day.
Back in my day. But it's the truth of it, though. It is. It's a lot easier to save a little bit starting early than have to save a lot later. The other thing, too, what happens is when you try to save a lot later, when you have those market downturns. I know we're going to talk about that in our next podcast, but market downturns are a lot bigger deal when you really have a lot less time for retirement and you are really under the gun to try to save as much as you can. I think you're more prone to potentially make a mistake even at that point. And how many times, staying on the theme of 401ks, how many times have you heard a client say that when they started the 401k, there's always somebody at work is kind of the investment guy everybody asks, right? And or there's somebody that when the market made a misstep or had like this spring, the market had a meltdown a little bit, right? They went all cash and they stayed cash. Well, you can do that, but when do you get back in?
Yeah.
That's the tough part. But I mean, how many times have you heard that where the people go to other people at work and say, "What are you doing?" Or the person they perceive as the person that knows about investments from that standpoint.
Yeah, everyone wants to know what's going on, right, and time it. It's just not that easy. So if you have cash on hand at that time when the market's down, great. Great time to buy, but not everyone's that lucky all the time. So the best way is really, over a consistent amount of time, dollar cost averaging, putting that money in there on a consistent basis, time after time, year after year, long term.
So we talked about a lot of riveting stuff here. I thought maybe we could take a little time and talk about some fun stuff, something exciting. So if you have more questions about a 401k or contributing to any of the employer-sponsored plans through work, just give us a call, and you call us at 715-341-8899, or you can visit us on the web at eliteretirementgroup.com. Schedule time to visit with myself, Victor, Matt, or Michael. We'll be happy to chat with you, share with you some more information on the 401k and stuff that's more specific to your situation. But what I wanted to do with the last little bit we have left here is have a little fun about talking about maybe hunting, because we're in that time of year. Yeah, so you guys have an advantage. So we have a buck pool that we're doing. And the buck pool is is it points and spread?
I think so.
Points and spread. So
Are you able to move the spread? Is it adjustable?
Well, Evan might have something to say about that.
Yeah, you'll have to ask him.
But I think his was clearly the winner last year.
I would say so.
But this year, and you got a nice one last year too.
Yeah, nice 8-pointer.
Yep, and which is great. I mean, everybody got a buck except for me. Michael got a nice one. Evan got a nice one. Victor, I was left out cold.
You're not quite ready to shoot the spike.
No, I'm not going to shoot the spike.
But you're
getting
there.
No,
so
I'm not getting there.
If a spike walks out in front of you and Haley, because you've never shot a deer with Haley, right? You're not going to.
We've already done that. We've already passed the spikes.
All right.
So
not even this year?
No. So we have the trophy. We should have the trophy here. We should show everybody the trophy. So we have a trophy that we like to pass around for the buck winner, and Evan is the buck winner from last year.
Much to Victor's dismay.
Yes, much to Victor's dismay. Victor thought he had it in the bag. He entered
nice
early. He did shoot a nice deer. I just feel left out, and I don't have any prospects this year either.
I feel like you're saying there's no deer, and all of a sudden there's going to be a big one that pops out.
I hope so.
Or maybe that's what you're trying to play.
That would be pretty good. That would be great. That would be great. But I guess we'll have to keep everybody posted. There's no entries yet.
No entries yet. Victor
So-
tried.
Victor tried. So we'll make sure that we post some entries along with our podcast and on our maybe not on our website, but on our Facebook page when it comes to the buck contest. If you have a beautiful buck that you shot and you want to share that with us, we'll share that with the world as well. So you can send that in and we'll post it on our Facebook page so the whole world can see. We turn off comments so nobody can be picky or mean, which is great because people can be sometimes. But anyways, so if you do have a Shoot Nice buck you want to share with us, that's awesome. We'll share it with the world. We'll keep you posted with our struggles. Our successes.
Yeah. Cross our fingers.
Cross our fingers. So thanks for joining us for the Elite Wealth Podcast, and tune in next week when we talk about market correction.